Real Estate Pro Talk is a live radio talk show dedicated to educating its listeners on the entire spectrum of real estate matters. Part of the American dream is owning a home or investment property, or perhaps even becoming a real estate agent yourself. Paul Vanas and his team of real estate professionals have over 250 combined years of experience in the industry. In other words, we can make it happen for you. Why go down the road less traveled when we can put you directly on the real estate superhighway? Whether buying or selling in today's complicated real estate market, or if you just need advice about jumping into the real estate business for a career change, you'll need a decisive edge based on experience. Call Paul Vanas at 401-265-6144 for a free, no-obligation consultation. That's Paul Vanas at 401-265-6144.
Good afternoon and welcome. My name is Paul Vanas and welcome to Real Estate Pro Talk. This is a real estate-oriented program which will cover a variety of topics every Friday afternoon from 3 to 4 p.m. here on WOON Radio. Some of the topics we'll be talking about during our time together will be how to buy and sell a home, how to choose a real estate agent, how to choose a mortgage broker, flipping real estate, staging a home, home inspections, private mortgage financing, and a whole lot more. I've been in the real estate business coming up on 40 years now, of which I own a real estate brokerage company, a real estate school, and a land development company. All of the knowledge that we're going to try to impart on you today is based on the continuing education classes that I teach licensed real estate brokers and agents, along with my personal experience and those of our expert guests. The goal in doing this is so you'll have the information in hand when you meet a seasoned real estate broker. You're welcome to call us today at 766-1240, and of course at my cell phone right after the show anytime at 401-265-6144. Today I'd like to welcome Diego Rodriguez of Lurod Tax Services. Diego is a CPA, and CPAs go hand in hand with owning real estate because you need good tax advice if you're going to own property. Good afternoon, Diego. Say hello to our audience.
Hello, Paul. Thank you for having me here. And I completely agree with you. You know, if you're going to be buying and getting financing, then definitely having a good tax return is the way to go.
That's great. Now, Diego, you have a couple of advantages. You're bilingual, right?
Yep, fluent in Spanish.
Spanish, English. How about French and Italian? Any of those?
Not yet.
Okay.
It's in the works.
But of course, the Spanish market is growing, as it is in the Northeast here. I do this with every show because I'm always interested on how people got their start. Diego, how did you happen to stumble into accountancy? Is this something that you lifelong, you knew you wanted to be a CPA when you were 6 or 7 years old, or is this something you kind of fell into as time went on?
No, so that's something that I fell into. When I was in high school, I always knew that I wanted to do something in business, but I wasn't sure what I was going to do. And when I was at the University of Rhode Island, I took my first accounting class. And I fell in love with it.
Really?
It was very easy for me to follow, to learn, and I kind of just kept going with it ever since.
Wow. So you've always been a numbers guy.
Yeah.
The numbers have always been rolling around in your head. That's great.
Yeah, and always thinking about good opportunities, business ideas and execution.
Wow. So now you graduated from school and you went out and you became a CPA?
Yeah. It was challenging, 50% pass rate.
Wow.
So I definitely had to spend a lot of Friday evenings and Saturdays putting in a lot of time to study and learn.
Yeah, that's not easy. I'm not a CPA, but I'm sorry, I'm not an accountancy guy, but from what I understand, that's not an easy exam to tackle, right?
Correct.
Wow.
But it was worth the sacrifice.
Wow, that's great. Get it over while you're young, right?
Yeah,
wow.
Right. That's why people kiddingly say CPA can't pass again.
I never heard that one before.
Yeah.
That's great. Now, is that something you had to take locally? I know I had a friend, I think he had to go to New York or something to take his CPA long ago. And again, I don't know how it works, but is that basically what you had to do?
Well, it's the same exam in all 50 states.
I see.
So you can go anywhere to take it, but I did it locally in Warwick.
Okay.
And then the other half, I did it in Worcester. It all depends on the availability that the testing centers have.
Wow. Boy, and just remembering, like I said, I don't want to belabor the point, but a friend of mine, he was studying these FASBs, and there's which I won't get into that with the audience, but it was pretty deep stuff. It's just like memorizing the law, only you're memorizing accountant law, and boy, that's great. So congratulations on that. Tell me, Diego, what kind of because we're a real estate oriented program, and I'm sure you cover a whole spectrum of accountancy, but tell us the different types of accountancy services that you offer.
All right. My firm specializes in tax planning strategies, and we're a full-service firm offering accounting and bookkeeping, small business, and investor tax returns. So we do work with folks who have rental properties, commercials, and help them like get everything aligned as far as what should be depreciated, what's the period that it should go over, and things like that.
So, so the small business services, that must be, quite involved, because people who have small companies, they can't afford to have a full-time bookkeeper on staff, right? They're using the software, like the different software packages that are out there, and then you guide them along in that practice. That every once in a while you go in to make sure that they're doing okay, is that kind of thing? Yeah,
you're correct. So you see two sides of the coin. Some people decide to do it themselves. They'll get like a Quicken or a QuickBooks, and do it themselves, and I'll come in and review it, quarterly. And there's others who just completely outsource it.
I see.
And it's challenging because as a small business owner, you're wearing multiple hats.
Right.
And the accounting one and the taxes is a very important hat that you want to make sure that you're getting right.
Yeah, and I always, of course, it took me a long time to figure this out until I got burnt. You try to do everything yourself in business, and not having the right, accountant can be very expensive. If you're not, especially if you're trying to do things yourself and you're unaware, because the tax law is changing constantly. And if you're unaware of the changes, when I say I don't mean you personally. I mean, here I am. I own some properties, and I'm doing things to the properties, and I'm still using, the 1986 appreciation, accelerated depreciation tax code, which no longer exists. And then all of a sudden, somebody tells me, no, you're doing the wrong thing, and so on and so forth. But tell me, what's the typical profile of your real estate clientele, the people that come to you who own properties?
Yep. Like I was mentioning earlier, so those who have existing rental properties, I have some with commercial properties, dealer properties, and that's more what people refer to as flips in commonly.
Yeah.
Those are taxed very different than others. And then someone who's continued to invest in other real estate assets and is looking to get out of hard money lending.
Okay. So now you just touched on a subject, dealer properties. How are those taxed? I mean, are those taxed like capital gains or ordinary income? What's the typical tax rate on those things?
Yeah, so like dealer property, because it's inventory to the owner, it's treated as paying self-employment tax, which is 15.3%.
Okay.
And income tax as well.
I see. Okay.
So, so if you're not careful and you're doing a lot of flips, a lot of your investment, the return on your investment can go towards taxes.
Really?
And that's one of my goals. I try to prevent that from happening by coaching you up front.
I see. Wow, that's pretty good. So the property owners that that you coach or you guide along, from an accountancy point of view, what should the average person take into account when they're buying a piece of investment property? Is there any particular format that you like to follow?
Yeah, well, Paul, it depends. There's no generic answer to this question. So it's going to be a little bit different for each person, right? What I usually tell people is try to have an exit strategy. So when you're buying the property, think about how you're going to get rid of it. And, think about, is it going to be a primary residence? Are you going to be investment property? Again, going back to dealer property, because a taxable sale of a property that qualifies as primary residence generally pays lower taxes than the dealer property.
Okay.
Because with the primary resident, you get the exclusion, whereas the investment property is capital gains, and then the dealer property is ordinary income. So if you have your exit strategy, then we can come up with a plan accordingly.
I see.
And then, not to get too off topic, but let's say, for example, if you do a 1031 exchange to defer some taxes, there's a clause that doesn't let you move into as your primary residence.
I see.
So if you're eyeing that at the house as your primary resident, a 1031 would not be a good fit for that situation.
Right,
That's why it's
right.
good to have the exit strategy in mind
Exactly.
beforehand.
So basically, there's two types of investment from what I'm hearing from you. There's the type where, like, let's say it's a 2-family house or a 3-family house. You're living in one of the units, or the client is living in one of the units, and that's their home. And then the other half or the other third of the property is the investment.
Correct.
So those are treated differently. I mean, from a taxation point of view, from the house you live in to the house, the houses or the units that you're renting out.
Correct. Like if you were to sell that double unit or triple unit, then if it's 2 units, half of the proceeds would be your primary residence.
Okay.
And the other half would be your investment.
Oh, okay. All right. And you have to keep tabs, I guess, of over the years of.
Exactly. Yeah. So so you start with your purchase price, and you would depreciate that as an asset.
Yep.
And then any improvement that you make every year,
Yep.
the portion that goes towards the investment side
I see.
would be eligible to be depreciated.
I see.
But the side that goes to the unit that you live in, then that's not depreciated. That kind of gets tacked onto your cost.
I see.
Where it gets tricky is you'll have someone who like buys a 2-family and they'll live on the first floor and they'll fix the second floor.
Right.
And once the second floor is fixed, then they'll move upstairs and fix the first.
Okay, I see.
So that kind of throws a wrench in it,
Yeah, and that I would think that's quite common because, like, when I started, way back when, long before the earth cooled in real estate, it was always customary if you were going to live. Let's say you bought a 3-family house, the owner, if they're going to live there, would live on the third floor, because you get the better rents on the first and second floor, obviously, and you just stay on the third floor. And the third floor was a kind of an iffy unit. It didn't really matter how fixed up it was because that's your unit, and then so on and so forth. The primary goal was to get better rents on the first and second floor. But so now, if that's the case, if someone fixes up another unit and then they depreciate that unit, and then all of a sudden decide they're going to move into that unit, what do you have to do at that point? I mean, is there anything is there special paperwork that has to be filed or on your tax return?
Well, what you want to do in those situations is you want to, first of all, have good records of your expenses, right?
Yeah.
And then what you would do is you start the depreciation on the second unit because you're not living in it. But once you move into it, then you would stop it.
I see.
And you still remember to save that information,
Yep.
because depreciation, whether you change preparer or CPAs year over year,
Yep.
that follows you until you dispose of the property.
Okay.
A lot of times, when I get a new client, I'll look at the prior return and I won't see the depreciation,
Yep.
and I'll ask them about it, and then they will have to go back to the prior person to get it from them.
To see what they put down on their returns. Okay.
Exactly. I always like to go back to the HUD
Yep.
to see what they purchased it for versus what is on the tax return.
Okay.
And then if they made improvements to it, I want to make sure we capture that as well.
So you start off at ground zero. You go back to the day they bought the property and kind of try to push it forward, or
Yeah, like if it's feasible. I mean, if they bought this house 50 years ago, it makes it
obviously.
challenging.
Yeah, right.
But if they purchased it within the last 5 to 7 years,
Okay.
I like to go back just to see, all right, did we start at the right cost?
Yep.
And then just to see, usually you'll see, for example, 2015 improvements, 2016 improvements, or if they purchase appliances, you'll see those listed out. Those are the kind of things that I'm looking for
I see.
to see if they were expensed right away, if they're being capitalized,
Yep.
how many years.
I
Because
see.
sometimes you can find savings for a client by accelerating some depreciation.
So every year when they're coming to you to do their taxes, they're sitting with you once a year, and you have all this stuff in the computer from the year before, so you can basically ask them, well, did you do this? Did you do that? Is that basically the way it works?
Exactly, yeah. So
Okay.
throughout the year, they'll kind of reach out and say, hey, I'm thinking about replacing the furnace. Is that deductible?
Okay.
And then I'll say to them, yes, and make sure that if you're going to hire someone, you get a W-9 so we can do a 1099 later on.
Ah, okay.
And that's another, probably
Right.
another
And
day.
A lot of people don't do that. They just go out and run out and make the improvement, and wow.
Yeah, and maybe you're paying cash or something, and then it makes it more difficult for you to
Right.
get a deduction.
Right. Yeah, I know that in my business on the construction side, trying to get the W-9s after the job is done, the chase is on. It's very difficult to track them down because now people don't want to give their social security number. Where up front everybody's willing, but later on it's more difficult. So the tax advice that you give someone, if they're buying a house and going to live in it or just investment property, it's really two different roads. They're kind of similar, but there's two different roads you go down, right?
Yeah, absolutely. I mean, everything starts on Main Street, and then from there, if it's going to be a primary residence, you got one set of advice because the expenses you can write off in year one is going to be a lot different if it was investment. And then if you're going to be flipping, dealing property, that's a completely different advice.
I see.
So depending on which road you go, which path, is a different set of advice.
So the people that live, your clients that live in the house, do you in advance of them doing their first year's tax return, do you give them some sort of list of things that they should bring with them to you when you sit down and do their returns, like a checklist kind of thing?
Yeah, definitely. We use tax organizers
Okay.
to make sure that we're capturing all the relevant expenses.
I see.
Typically, I want to say the first year is the most challenging year because that's kind of when we have to get used to, acclimated how to work together.
That lays the groundwork for the future, for the relationship.
Correct. After year one, you already know what I'm asking for, and you're more prepared.
Right.
That's usually when I tell them like the things they're doing right and the things they can do better.
Right. And of course, I would think too, no one buys a house on January 2nd. It's always through the year, so you have to make adjustments for not being a complete year or just 6 months or 2 months. If you buy a house on, December 29th, you've only owned it 2 days in the year or 3 days into the year, and then you have to make all those adjustments, right? And then so the following year, that's when the routine's going to start, I would think, right?
Yeah, correct. I mean, if you were speaking to a realtor, I'm sure they want all the deals to close in January.
Right.
Because they don't have that much activity.
Exactly.
But the reality is, the spring market is when it heats up throughout the summer. So if you're a seller, you want to sell then because you're probably going to get the best prices.
And that's a good point, too, because, at one time the market used to slow down in December. I found the last couple of years the market has been just as busy, mostly for investors, because a good investment is a good investment in December as it is in July, as it is in September, where the obviously the owner-occupied people, they want to sit back a little bit. There's not as much inventory coming on the market for them to occupy, so they kind of slow up. But I find a good investment could be, I gave a story a few weeks ago on the air here that I remember I had a guy on Christmas Eve. I mean, here we are, 8 o'clock at night in the snow, and he had to get this place that day because it was such a good, had a great cash flow and good return, and it was a unique situation. The seller had to get out and get into a contract before the end of the year, and it was something when they ended up buying the property. They didn't actually close in December, but we ended up putting it in agreements on Christmas Eve. My wife wasn't too happy, but I was home a little late that night. But in any event, what are the typical deductions? The deductions that people that you ask them for every year, I mean, to keep track of in their tax returns.
Yep. And that goes back to the, you're going to hear me say it depends. Right. That's the typical response from a CPA.
Yep.
But it goes back to like what type of property is it? For a primary residence, you're normally looking at like your mortgage interest and property taxes are like the two big deductions that you get.
Right.
PMI or MIP, depending on where you go, is the primary mortgage insurance. Mm-hmm. And that used to be deductible, but in 2018 it wasn't. It wasn't extended. So that's a deduction that some people missed out on.
Really?
And I want to say, like, for example...
so when you say missed out on, if you started deducting the mortgage insurance prior to 2018, could you carry that forward? Or
No.
is it at 2018, it stopped, there was no more deduction?
Exactly, yeah.
Okay.
So if you didn't refi in the case of an FHA or... had an appraisal done,
I see.
Then it's something that you paid that you didn't get the benefit.
Right. Okay. So the other common deductions would be, you mentioned mortgage interest, which is huge, because that's 95% usually of the mortgage payment every month. That's pretty huge. And then property taxes, right?
Which go up every year.
Which go up every year, and then fire taxes. Now, how are those handled differently from the homeowner who lives in one of the units as compared to someone who just owns a 2 or 3 family property and is strictly investment? Are those handled differently at all?
Yes. So when there's owner occupied or partial owner occupied, those expenses you allocate it, right? So if it's a triple decker, you do 1/3 owner occupancy.
I see.
So you take a third of the interest, third of the insurance, third of the taxes. So that stuff, the things that are deductible goes to a Schedule A itemized deduction.
I see.
And then the 2 other floors, that's going to go on your Schedule E and go against the rents that you collect.
Oh, okay. So they are offset against the rents as an expense.
Correct. Yes.
Wow. Are there any other typical deductions that they use? One can like improvements if they I don't know, they put a kitchen in or they put a new refrigerator and stuff like that. Those are all deductible.
Yeah, actually, one of the things that I've noticed is a lot of times people get a little aggressive. So let's say, for example, if you change one window, you can write it off as a repair and take it in the current year.
I see.
But if you change all the windows in the property, that's more of an improvement, and you should really be depreciating it over 27.
Over time. Okay.
Over time, yeah.
Really?
And that's kind of one of the things you want to be careful is if you make a small repair, you take it in the current year.
I see.
If you make a substantial improvement to the property, you want to depreciate it over the appropriate period. One of the good news is the 2017 Tax and Job Cuts Act, commonly referred to as TCJA, because it's a very long name, created a new deduction for owners of rental properties, and then also for those who are working with dealers. So if you have a rental property, you can deduct it's 3.5% of the value of that property as a deduction, and then if you're more on the dealer side, you're able to deduct 20%.
Really?
Of your profit.
Wow.
So that definitely helps out.
That's huge.
So for residential, 3.5% of the value or the cost of the property. For dealer, 20% of your profit.
I see. Is this something new that just came out? Or?
Yeah, at the end of 2017, when the tax reform took place,
I see.
It was something they created to help small business owners.
Wow. Something else too. Someone told me about the. If you buy and you can clarify this, if you buy a property and you live in it, and then you have a capital gain, if it's over, if you live there a couple of years, let's say the property goes up $40,000 or $50,000, and you sell it, and it's under a certain amount of property, the sales price is under a certain amount. So let's say let's just use an example. It's a $200,000 house, and then you bought it, and it went up to and you lived in it, and it's up to $250,000 now, and you sold it. Someone told me that $50,000 of gain, as long as you live there in 2 years, is not taxable anymore. Is that true?
Well, yeah. So it's called Section 121. So that's the primary homeowner exclusion.
Yeah.
And you're right. So if you owned it and lived in it 2 of the last 4 years, if you're married, you can exclude up to $500,000 of gain, and if you're single, it's $250,000. But you just want to clarify. That works well with single-family residents.
Okay.
Because if it's a multi-unit, you have to allocate it, right? So if it's a two-unit, half of it doesn't pay tax if you use the whole exclusion. And then the other half is still going to be taxable as an investment property.
Really?
So you're going to have both scenarios there.
I see.
Whereas a single family, if you have a $50,000 gain, then that wouldn't be taxed.
And that once you make that, once it's been 2 years and you made that money, no one's ever going to tax you on it forever, right? So
correct.
That's fantastic compared to, because it used to be you'd be taxed on it, wasn't it? Unless you bought another house or something within a year. I think the old way you had to buy another house worth $1 more. This is going way back again.
Maybe in '86.
Yeah, exactly. And then you had to keep, piling on and piling on and piling on. But
that sounds more like the 1031 exchange.
Okay.
So like if you 1031 your gain into another property, it's supposed to be of equal or greater value. If you take money back, it's called boot, and then that becomes taxable for you.
Wow, that's great stuff. All right. Well, you know what? We're going to be right back with Diego. We're going to take our first commercial break, and we will be right back.
Real Estate Pro Talk is a live radio talk show dedicated to educating its listeners on the entire spectrum of real estate matters. Part of the American dream is owning a home or investment property, or perhaps even becoming a real estate agent yourself. Paul Vanas and his team of real estate professionals have over 250 combined years of experience in the industry. In other words, we can make it happen for you. Why go down the road less traveled when we can put you directly on the real estate superhighway? Whether buying or selling in today's complicated real estate market, or if you just need advice about jumping into the real estate business for a career change, you'll need a decisive edge based on experience. Call Paul Vanas at 401-265-6144 for a free, no-obligation consultation. That's Paul Vanas at 401-265-6144.
And we are back with Diego Rodriguez of the Lurod Tax Services. Did you have a good time with Thanksgiving yesterday, Diego?
Oh, absolutely.
No day off. Did you have the day? Did you actually have to work yesterday at all, or did you have the day off?
No, I had the day off.
Okay, I had to work a little bit in the morning, and then of course, today I had to do some things. I had to clean the gutters on the house and pull the leaves out of the gutters. And of course, everyone listening in real estate, you should clean your gutters before that snow is coming. And of course. Your chimneys too, if you have a pellet stove or a wood stove, the spiders like to make nests in there, and it slows down the exhaust gases coming out of the stove. You should check on those once a year. But Diego, we've talked about a few bullet points so far. What are the common mistakes, Diego, that people make when they prepare their tax returns without using a tax professional? I mean, they just kind of wing it on their own, or they'll go out and buy one of these $29 programs and think they can get through it. What's your experience with that?
Well, normally the first thing I hear from them is, it's simple. I can do it myself.
Yeah.
And that may be the case if you have just like a W-2. But once you start, acquiring properties, it's not so simple. So when I usually poke around, I'll see missed deductions. Mm-hmm. And one of the common one is depreciation.
Really?
And when you think about it, depreciation is a nice non-cash deduction that will lower your profit. And in that situation, you're paying less tax.
I see.
And one of the things that I hear also from those folks is like, well, I want to make sure that I'm showing a profit because I want to be able to refi to buy another house. And, from my conversation with lenders, I believe with what you paid for, like insurance, interest, taxes, and depreciation are all add backs anyways that they can use to refinance you.
I see.
So you're kind of missing out on a deduction that you can take advantage of that is not going to impact you at the time to refi. So why?
And you're picking it up now instead of later, because so let's say, for example, you just made me think of something. Let's say later on you miss something and you decide you want to take it. If I have to file an amended return, right? And that costs money to do that. It has to be worth the while to file the amended return for whatever that deduction was. The money has to be better on one side than the other, correct?
Yes. And then the other thing, especially with depreciation, the way the tax rules work is the depreciation that you took or that you should have taken. Yep. So let's say you've owned the property for 10 years, never depreciated, and now you're going to sell it.
Yep.
Well, when you calculate the gain, you still have to adjust it for the allowable depreciation. So it's like you're not getting the benefit, and now you got to go file additional forms so that you can get the depreciation that you missed out on.
Okay.
And it's just, you can hear money signs right now because it's just costing you more money.
Yeah, that's very interesting because I didn't know that. So if you don't take the depreciation, it's going to catch up with you eventually anyway.
Exactly.
Wow, I didn't know that. I didn't know that because I've heard people do that. They think, well, if I don't depreciate it, that's, my basis in the property is going to be higher later on, and therefore there'll be less capital gains. So you're saying that it doesn't matter. You're going to pay the fiddler now or pay it later, right?
Exactly.
So it's true. So you might as well take advantage of the write-off now, and that's money now that you could have towards either, extra money or just towards other investments.
Exactly. Yeah, it's more money that you can put into your investment account that you can now get a higher return on, and now you're going to have more money to enjoy for yourself instead of paying higher taxes that you probably won't recoup anyways. Because after 3 years, even if you amend, that money's not coming back to you.
I see.
The statute of limitation has lapsed.
Really?
So that's kind of why you want to take advantage of it.
Wow. Now, the mortgage interest deduction and the property tax deduction that we all take, I guess everyone who has a mortgage. If you don't have a mortgage, you don't have to worry about the mortgage interest deduction, but everyone has property taxes if they own a piece of property. How does that affect their mortgage payment, their effective mortgage payment? I mean, do you have like a calculation that you figure out what their effective payment is, after the deductions have been made? Or can someone come to you in advance and say, hey, Diego, I'm buying this house. It's a $200,000 house. I'm going to use an FHA mortgage, which means, I'm going to have $15,000 a year in interest write-offs that I don't have now. How will that affect me? Is that something?
Yeah. So like when we do the projections, for example, the tax planning, so we do projections and tax planning depending on the situation. But there in a simple projection, we can factor in those costs. Where I would say is it depends on where you're going to write it off, right? Because when you're renting, you're generally not allowed any deductions, right? Because you don't have interest or taxes.
Right.
If it's going to be your primary residence, you normally take it as an itemized deduction.
Okay.
Well, going back to the Tax and Jobs Act, the standard deduction was doubled,
I
right?
see.
So that means that a lot of people who used to itemize were forced into the standard deduction. And as a result, even though you used to get that benefit before, you're not any longer getting the benefit.
Okay. Wow.
So now if you still treat it as a rental property, there is a benefit there to you, but there are strategies available so that you can maybe itemize every other year if you can't itemize every year like you used to.
Yep.
And that's something that I would almost propose to them is just look at it because, just to get a little more detail, taxes before you could write off 100%, right? So this is your property taxes, your car taxes, the taxes that you pay to the state of Rhode Island, all that, whatever the number was, you wrote it off as an itemized deduction.
I see.
Now that's capped at $10,000. So if you're paying $18,000 of taxes, you're missing out on $8,000 worth of deductions.
Wow.
And that was one of the state and local tax limitations that came with the Tax and Jobs Act that really affected, the middle class.
That does, especially if you live, let's say you live in an affluent community like Barrington and your taxes are $15,000 or $16,000 a year. You're saying that it stops at 10. You can only deduct 10,000 of the 16.
Correct.
Wow.
Like I'm thinking of a client that I have that as a couple, their total itemized deduction in 2017 was right around 33,000.
Really?
But with all the limitations that happened, the tax was a big one, and then unreimbursed employer expenses is the other itemized deduction that was limited.
Yep.
So they went from 30-something thousand to a $24,000 standard deduction.
Really?
And it took a while to explain to them all the changes that took place and how it impacted them.
That's substantial.
Absolutely.
And I know kind of off the sheet here, and maybe you can answer this, but I was trying to, explain to a young buyer, that his mortgage was $1,200 a month, and I was saying, no, but after taxes, it's really like in deductions, the property taxes and mortgage interest deduction, your real payment is like $800 and change a month, let's say, and you can't rent. You'd never be able to rent this property for $800 a month. But from what I understand, are they taking out less now in payroll taxes than they were like under the old tax, like 2017? Because someone had told me that they're actually taking out less money from you now than they were prior to. So that's less money to get back later on. Is that accurate?
Yeah, for the most part.
Okay.
One of the things that I usually do is I do a year-by-year analysis of the change. So what I've noticed is, all right, the income went up, the tax due goes up as well. But then I say, all right, but the withholdings either stayed flat or went down. And what that means is if the withholding stays flat or decreases, you're seeing a bigger paycheck each week.
I see.
And as a result of that, if you got a refund, that means that you probably got a smaller refund. And if you owed, that means you owed more.
Okay.
And I think that was the big surprise to a lot of people.
Right.
They weren't expecting the reduced withholdings.
Yep.
And that kind of caught them by surprise.
So they
taxes.
wanted they were used to getting X amount back in April or when they do their tax returns, and they didn't get that. So they thought, I know some people that thought they were being cheated because they were getting, and I was telling them, no, you're getting more per week. But people want both. they want more per week and more at the end of the year, right?
And that's one of the things that during the 2017 tax filing season, I spent a little bit of extra time telling all my existing clients, look, just to give you a heads up, this is what's coming down the pipeline. So if you don't want it, then change the withholdings now.
I see.
I think the only people that I met with during 2018, calendar 18, that weren't happy with the outcome with like the new clients that had a different expectation. I didn't get to work with them last year, so I didn't get to set them up, in the right expectation.
It's fresh, yeah,
exactly.
Yeah. You new people, you can start off right, and they're on the right road. So, from an investor point of view, capital gains is a big thing, and how does capital gains work? We hear that there's a capital gains tax and a self-employment tax, but if I buy an investment property and I sell it and I make a profit, is it capital gains or is it self-employment or a little of both?
Well, yeah, good question. So I would say it depends on two factors, right? So one is the type of property. So is it primary residence, investment, or dealer?
Okay.
And then for how long did you own it?
I see.
So if we go into the investment property, as long as you owned it for 366 days, so a year and a day, or less, it's going to be treated as ordinary income. So short-term capital gains.
Okay.
So short-term capital gains means there's no self-employment tax, but it's going to be taxed at whatever tax bracket you fall into.
Okay. All
right? Whereas if you hold it for 366 days or more, then it falls into your long-term capital gain. So depending on your tax bracket, it could be anywhere between 0, 15%, or 20%.
I see.
And if you're a really, really high tax bracket, it could go as high as 23.8%. That's like the max capital gains.
Right.
Now, if you have dealer property, whether you owned it for a day or for 10 years, dealer property never becomes eligible for capital gain.
Wow.
Unless you change the character of the property. So,
see.
for example, if you buy a property with the intention to flip it, it's dealer property. Let's say, for example, the rental income market is strong, but the selling side is weak. So you're like, you know what? I'm listing this property, sitting in the market. I'm not getting what I want for it.
Right.
But from rent's perspective, you can collect premium rents. So you say, you know what? I'm just gonna put some tenants in here, and now your outlook is to rent it for the next 2 to 3 years.
So it changes the classification.
Exactly. So now after you rent it for a couple of years, you decide to sell it. Then you can now be eligible for investment property capital gains. But you can't without going through a conversion like that, just sell it and expect to pay capital gains tax.
That's really interesting because we were talking about that before we came on the air about how that's a wise tax strategy advice that you give people that it really can make a big difference in how much taxes you're paying, right?
Exactly, yeah. And this is about planning things, up front in your exit strategy, and being able to be in a situation where you can be flexible. If you were in hard money, maybe you may not have that flexibility because holding the property for an extended period of time with hard money is just not feasible.
I see.
So you need to be able to refinance if you need to, or just sell it at a lower cost.
Yeah.
If that's the only exit strategy you have at that point in time.
When you say hard money, it's because of you're paying a higher interest rate, right, than a regular conventional rate at a credit union or a bank or whatever.
Yeah, correct. I mean, I'm not a mortgage professional, but I think rates are around 4-ish, 4 to 5-ish.
Yeah, absolutely. You're right.
And if you go to hard money, I think they're between like 10 north of that.
Yeah, 10 all the way to 18.
Yeah.
Wow.
So you can see, holding a property at such a high rate. I mean, all that interest is deductible,
right?
But forget the deduction. Is it a good investment at that point?
And in the long run, wow, that's interesting stuff. So really, someone just getting into this for the first time, everyone watches TV, they watch HGTV and Flip and Flop and all these programs on TV. And it sounds really glamorous, that you buy $100,000 house and then all of a sudden you sell it for $150,000. But people don't take into consideration the tax ramifications. I know most people don't. When I had agents years ago who'd come and work for me, they become very successful right off the bat, and so the first thing they do when they get that first big commission check is they run out and they buy an expensive car. And then the next commission check comes in and they go out and buy something else. And then at the end of the year, they're 1099 employees. They didn't put any money away for taxes, and then all of a sudden, come March of the next year, there's a huge problem.
yeah, they get on the payment plan. One of the things that I've been noticing with the investors that I work with is that they start out doing flips, and then as they understand how the taxes work, they switch to a buy and hold strategy.
Okay.
Because they're like, with buy and holding is a lot better for me.
Right.
And then the same thing with the agents. Like if you're not making quarterly tax payments, and you also have to be doing some sort of like retirement planning as well, because those are the deductions that are available to you, because you make most of your money, with your head in, and there's not too many. Your brain cells are not deductible.
Exactly, that's great. No, so the rule of thumb then is that they should call you in advance, or at least at the very beginning of the process, to at least explain to you what their goal is, and then you can tell them how to back into that goal financially, right?
Exactly, yeah. Like within what's legal within the IRS guidelines, you can coach them to say, look, these are the type of decisions you want to be making, so that at the end you get the results that you're looking for.
That makes sense. So what's the typical, what's the fastest growing category of your clientele? Is it young people? Is it investors? Is it... Who's banging on your door right now? Right?
Yeah. So I'm in my mid-30s. Yeah. So my practice, believe it or not, my clients all around the same age as well, which is good. We're all growing together. Yeah. I'm getting a lot of knocks for tax planning strategies. And the reason why is because there's so much saving opportunities available to the client that they're like, all right, how can I, start thinking about my ROI after taxes, return on investments after tax. Yep. And that's where I definitely spend a lot of time with clients to meet their goals. Yep. It's a nice niche market, of successful business owners and investors who are really great at what they do, but they're not good at the taxes. And that's kind of where I come in to save them some money. Like when I do a tax planning engagement, on average, the return on investment is 200%.
I see.
And that's after my fees. Right. So, so we'll sit down, look at your situation, see what we can come up with. And then after fees, if it's 200% or greater, usually is a home run.
That's a pretty good investment.
We just want to move forward and put it into practice.
Wow. So you have those people that, well, actually your age, that's almost perfect, because now you're going to grow, you guys are going to grow old together. Once you get established with those folks, you have those folks for another 30 some odd years. And that's great for your practice, right?
Correct, yes. And usually what I kind of look for is, like, if you're someone who's paying around $30,000 or more in taxes per year, you should definitely consider a tax planning engagement, because imagine you continue doing what you're great at, but yet you're having more money available for you for your investment account.
And that makes sense. We can't do everything. There's that mentality where we got to do everything. And I fix up old cars. I really enjoy fixing up an old car. And, I can't work on the transmission. I send the transmission to a transmission guy, and I go to the muffler guy for the muffler. I don't do all of that myself. So you really need other people to support your business and your investment strategies, and that's why I think it's so important. So when someone first comes into you and they say, "Hey, Diego, I'm starting in getting involved in real estate," what do you do with them? What do you sit down with them and have like a consultation meeting? What's the typical practice?
So the first step is to set up a complimentary discovery meeting, and we do a non-disclosure agreement to protect the privacy of both parties. And then during the discovery meeting is where, I listen to your needs and challenges. It's like a lot of times people come in and you're not listening to me. So this is like kind of like your chance to lay it all out there.
Yeah, getting to know each other.
Exactly, because that's going to be the keys to success.
Yeah.
Because based on what you're telling me of what your needs are and your goals,
Yeah.
then we can start working towards those goals.
I see.
So if you tell me you want to retire by the time you're 40,
Right.
I can't stick all your money in retirement accounts that you can't access before you're 59 and a half.
Exactly.
Because we're going to have 9.5 years or 19.5 years that you won't be able to touch the money.
Right, exactly.
So that's why listening is important.
Do you find people fight you? I mean, I have people in my business on the real estate brokerage side where, they ask me to come in and I'll tell them the highest and best use for the property, but then all of a sudden they think they know more than I do and they start fighting me. And I don't mean physically fighting,
Yeah.
I mean arguing with me about what about this and what about that, and I saw this on the internet and I read about this in the paper, and I tell them, look, no. And then it takes me a long time to kind of persuade them to get back on the track that I'm trying to put them on. Do you find that you have that issue? Or?
Well, I'd say it depends on the personality type.
Yeah.
I'm not very confrontive, so I don't get into arguments with clients per
But
se.
I don't mean argument. I mean,
No, I know.
just like a general debate over things. Some people think that they know more than the professional.
Yeah.
But yet they're sitting in your office to go to the professional at the same time.
Correct. And what I usually do with those type of people is like you do, you lay it out and you do like Mythbusters. Yeah. So I heard this and I'm like, yeah, that's correct. But because of X or Y, Z reason, you don't qualify at this point in time. Mm-hmm. However, if we make these changes, then you can.
Right.
Because I feel like there's a lot of like buzzwords. Like, for example, 1031 is a word that a lot of people come in asking for.
Right.
And if you already sold the property, it's kind of too late for the 1031.
I see.
And then also if it's dealer property, was not eligible for 1031.
I see.
So that's kind of where I do see a little bit of pushback, and I just coach them through it. And at that point, if they don't believe what I'm saying, you're more than welcome to get a second opinion.
Right. And then, of course, you're educating them for the next time. Right?
Correct.
Before it's too late, before they sell it, and then try to do the 1031. Matter of fact, we should have you back at some point in the future so you can describe from soup to nuts with a 1031. We won't have enough time today because we only have about 10 minutes left, but I'm sure that's a subject all in and of itself that you'd love to tell our audience about. Yes?
Oh, absolutely. Yeah, because I saw like one person who did a 1031 of a flip.
Mm-hmm.
So she flipped 131 into another one flip into another flip, and then sold it within 12 months.
Wow.
So you didn't get the benefit of the long-term, capital gains, and it wasn't really a proper one because of those.
The time frame.
Well, not the time frame. It was two dealer properties.
I see.
So it's supposed to be like rental property to rental property.
I see.
If it's property that's held for sale.
Like exchange.
Yeah, exactly.
Wow.
So I think it would be beneficial to take some time and talk about what's allowed and what's not allowed.
That's a pretty involved subject.
Because they're not cheap.
Yeah.
And the last thing you want to hear is, I just spent all this money to defer taxes, and you didn't accomplish the goal.
Right.
And you still ended up paying the taxes anyways.
That makes sense. Wow, that's great stuff. All right. Well, we got about 9 minutes left. We're going to take one more commercial break, and we will be back with Diego Rodriguez.
Real Estate Pro Talk is a live radio talk show dedicated to educating its listeners on the entire spectrum of real estate matters. Part of the American dream is owning a home or investment property, or perhaps even becoming a real estate agent yourself. Paul Vanas and his team of real estate professionals have over 250 combined years of experience in the industry. In other words, we can make it happen for you. Why go down the road less traveled when we can put you directly on the real estate superhighway? Whether buying or selling in today's complicated real estate market, or if you just need advice about jumping into the real estate business for a career change, you'll need a decisive edge based on experience. Call Paul Vanas at 401-265-6144 for a free, no-obligation consultation. That's Paul Vanas at 401-265-6144.
And we are back with Diego Rodriguez of Lurod Tax Services. Diego, we've hit a few things. We've hit some bullet points today, and of course, we only have an hour to talk, and we can, there's what you're talking about, in the descriptions today, the very in-depth subjects. But What the services, the ongoing accountancy services that you provide prior to the tax season, is there anything special that people should know, like before they come and see you? And when do they usually do their taxes? February, March? The last thing you want is someone showing up on April 13th, right?
Yeah. And one of the things that the analogy that I use is no different than Santa Claus. You think about that one day and you kind of have to get everybody their gift, but it takes a lot of preparation and coordination to get all the toys ready to go out.
Yeah.
And it's the same thing, like everyone's going to April 15. You don't want that person who calls you even like on April 1st onward with like, oh, I have this box of receipts and I need to get my taxes done.
Yep.
Because you have to make sure you're taking care of everybody who was prepared and came well before that date.
Right.
It's not fair to put someone aside to do a last minute return. But the things that are going on is making sure that all the bookkeeping is getting done. So I have the support staff working on everyone's books. We're making sure that estimated tax payments are getting done as well throughout the year. We're having consultations. We're preparing tax plans for existing clients so that we can present to them more ways or new ways to save them money.
Right.
And then once we get into this time of year, it's just doing some last minute pro formas just to make sure the salary's right for the S corps.
Mm-hmm.
Once we get into January, we're taking care of all the 1099s and W-2s, make sure those go out timely.
Yep.
From there, March 15th, your partnership and your S corps are due.
Mm-hmm.
And then on April 15th, you have your individuals and your C corp returns that are done.
Wow.
So it comes up fast.
I'm sure. And of course, you don't want anyone to have to do all this stuff at the last minute, right? Because that just creates chaos for everybody involved. I would think that.
Yeah, I feel like anything that gets rushed doesn't get done right. That's when you have missed deductions.
Yep.
That's when when things don't go out well, and you may have to do an amendment.
Yep.
So if someone comes like on April 1st, we try to come up with a way to get them an estimated tax payment out the door,
I see.
and then do an extension, and then kind of go through and make sure that we're calculating everything correctly and we're finding all the deductions. So if in the beginning of the year I said to you, all right, Paul, I have a strategy to save you, 250%.
Yep.
I want to make sure that when I hit send on that return, all the things we talked about that we're going to get accomplished, we're done.
They're all covered.
And they're all in the return so that we can show you the return on investment that we had promised you in the beginning of the year.
Right, that's perfect sense, perfect planning. So I know we only have about 4 minutes left, but do you, off the sheet here, Diego, I'm just thinking, do you have like an example of someone that came to you that, they didn't have any prior financial professionals, looking out for them, and they came to you, and then you took the ball and you saved them some serious money? Do you have anything in mind that can come to mind like that?
Oh yeah, I mean, I have a bunch of those. Like I have folks that, just by qualifying as a real estate professional, you save them $15,000. I have another one, not necessarily in the real estate field, but I have a client that's a physician, and in year one, saved them $20,000 plus $7,500 from amended returns of missed opportunities that were right there.
Wow. That's a lot of money.
Sometimes it makes me look like a hero, and I'm just like, I'm
right.
finding what the other person didn't.
That's great.
And part of the reason why I'm able to do it is because I spend a lot of time in continuing education, and I'm also going to conferences and learning new things that are out there so that I can come back and present my clients with the greatest and best.
Wow. So the tax codes, I mean, did these change during the year, like in the middle of a year? Like, so when you say you go to these conferences, is it how to apply a particular law, or does a law actually change mid-year?
Well, so some of the things that happen is, like, for example, the 2017 Tax and Job Act was really like rammed through at the end of 2017.
Right.
And even to this date, the IRS hasn't issued regulations on all of the changes. So our regulation is how the IRS tells you how they interpret and how we'll apply that law. So, for example, there was a lot of changes that were announced this summer for the new deductions for for rental properties.
Right.
So that's an area where I'm making sure that I'm staying current.
Yeah.
And then at the same time, there's like a court case that gets settled that impacts now prior case law.
Right.
So then you kind of see, all right, what were the facts and circumstances, so that when you apply that to your clients, you're able to get the same result.
Wow. Wow, that's pretty involved. So the continuing education is really important, I guess. While I have you, with a couple of minutes left, Diego, do you want to give the audience your contact information? Because I'm sure we have a lot of listeners that you've touched on a subject. Everyone's interested in saving money,
Yeah.
and everyone's interested in not paying more of their fair share than they have to. Can you give the audience your contact info, email, telephone number, and such?
Yep. So you can reach me by email at Diego, Diego, at Lurod, LURODTAX.com. You can reach me by phone or text at 401-489-9567. And actually, the best way, and I'll share it just with your listeners because the link is not on my website. If you go to LURODTAX.com/appointments with an S, if you go and you follow the links, you can set up an appointment with me.
Oh,
direct. And that sends me an email, it sends me a text. So you definitely get my attention that way.
Really?
And you can find the time that's convenient for both of us because only available slots come up.
That's fantastic. And of course, you had mentioned to me that you're more than happy to provide a financial consultation to any time, to any person who listens to the show.
Absolutely. I mean, once we get into like March 1st to April 15th, it gets a little bit tricky.
Yeah.
But outside of that window, I'm always available to sit down with anyone who's looking to find ways to maximize their return on investment.
Fantastic. Well, thank you for listening today to Real Estate Pro Talk. And we will be back next Friday from 3 to 4 here on WOON.